Okay, so name of the topic is free cash flow valuation. It's one of the fun readings at L2 because this reading takes us very closer to what the analysts will do in real life scenarios in equity research world. So we would learn how to do valuation of stocks using different free cash flow methods, namely free cash flow to firm and free cash flow to equity. So what we learn in this reading is, number one, why do we need to use these methods? Why not use dividend discount, or why not use other methods? Why free cash flow? That's one. Second, how do we calculate these numbers, and why do we calculate these numbers in that particular fashion? What is the interpretation of the formula? And third, then there is a lot of theory surrounding it in terms of, if this scenario is in this fashion, then how do you deal with those type of scenarios? So a lot of ifs and buts type of scenarios. So my approach would be, first 30 minutes we will build the intuition, we will do some numbers, and once you're reasonably comfortable with formulas and numbers, then we will start going through the learning outcomes. Okay, so let's get started. The starting point would be to understand how to calculate FCFF. So we've already done these formulas multiple times. There are four ways in which we can approach the formula. One is net income, or we can have the formula starting with EBIT, or we can have a formula starting with EBITDA, or we can have a formula starting with CFO. So net income formula would be net income plus non-cash charges plus minus working capital investment, the amount that you invest in your working capital. Then we make two adjustments here. We will say plus interest net of taxes and plus minus fixed capital investments. Now, if you look at the last formula, would you agree that the first three variables here are exactly same as CFO? So once we know these are same as CFO, we just plot the remaining values, which would be plus interest net of taxes and plus minus fixed capital investment. Is it fine? Then the formula which starts with EBIT, we will say EBIT into 1 minus T. What is this number called? This number is called NOPAT. So EBIT into 1 minus T is same as NOPAT. Now what you might want to appreciate is that if you take net income and if you add interest into 1 minus taxes, these two numbers would produce the same value, which means EBIT into 1 minus T is same as net income plus interest into 1 minus T. And once we know that it works in this fashion, then we just put the remaining numbers, so which would be plus NCC plus minus working capital investment plus minus fixed capital investments. Then the formula which starts with EBITDA, we will say EBITDA into 1 minus T. So we are not taking benefit of taxes on interest as well as depreciation. So if you are not taking on interest, that's fine, because we are right now on FCFF. We should be taking benefit of taxes on depreciation. So we will say plus depreciation into T. And these two values would be same as these two values that we have in the EBIT calculations. So we just plot the remaining numbers now, which would be plus minus working capital investment plus minus fixed capital investment. So let us put some numbers and let's see if all the four methods produce the same results. So let us say we have sales of 1000, COGS of 200, SGA of 200, depreciation of 100, interest of 100, then taxes of 180, and that would get us the net profit. So this is 400, 500, 600. Let's change the taxes amount. Let's change the tax amount. So your total expense is 456. So let's keep the taxes as 120, and that gets us net profit of 280. Are we together on this? Apart from this, there is a working capital investment projected to be of 50 and fixed capital investment projected to be 70. So now, using these 4 separate formulas, we want to test whether it produces the same results. So let's start doing formula number 1. Net income. So net income here is how much? 280. Non-cash charges, what should we taking? What should we take? Depreciation. Depreciation is 100. Working capital is minus 50. Interest adjusted for tax rate, what would be the tax rate? Tax rate would be 30% because your profit before tax is 400 and taxes is 120. So your interest is 100. 100 into 70%, this should be 70. And fixed capital investment is given as minus 70. So 280 plus 100, that's 380. Minus 50 would get us 330, and these two numbers would set off, which means your FCFF using the first methodology is 330. Let's look at the second method. EBIT into 1 minus T. You take EBIT, how much should that be? 800 minus 200, 600 minus 100, 500. So we take 500 into 1 minus T. So 500 into 70%, that would be 350. And this 350 should be same as this 280 that we have here plus this 70 that we have here. Are you following this? And then once we know it is same, we just plot the remaining values. So this should be 100, this should be minus 50, and this should be minus 70, which would again get us cash flow of 330. Let's look at the third method, EBITDA. How much is the EBITDA? How much is the EBITDA here? 600. So 600 into 1 minus T, so that would be 420. Then depreciation into T, that would be 30. Total is 450, if you'd observe, which is same as 350 plus 100. And then we plot the remaining values, which is minus 50, minus 70, which would again get us 330. And then what should be CFO? CFO should be 280 plus 100, 380, minus 50, your CFO should be 330. Interest adjusted for taxes is 70, fixed capital investment minus 70, and again we would get 330. Are we okay here? Now what the reading proposes, so in fact once we're done with FCFF, then we know that the difference between FCFF, which is the cash flow available for the entire firm, and FCFE, which is cash flow available only for equity shareholder, is difference of those values that we pay off to bondholders. So we pay off interest, but since we added net of taxes, we will remove net of taxes, and typically we will pay off debt repayment, which is a minus number. If it's a borrowing, it's a plus number. So you take FCFF, you say minus interest adjusted for taxes, minus debt repayment, and then the value that we get is FCFE. So FCFF minus the payment made to the bondholders, and it gets us FCFE. And what the valuation theory proposes, it says FCFE discounted at cost of equity should produce the value of entire equity. FCFF, when you discount with WACC, it will produce value of firm. And when you calculate value of firm, you can say minus the value of debt, value of firm minus the value of debt, and then it would get us value of equity. And in theory, the value of equity using this approach or this approach should be exactly same. So you do value of equity using the FCFE or FCFF, it will produce the same values. So what we would do now is do an example and check if that logic is really sound, where we will have a set of cash flows, we will discount them at WACC, and we will see what is the value of firm minus value of debt, that would be value of equity. Then we will calculate FCFE's discounted cost of equity, and then we will check whether the valuation is still the same. Are we okay? So let me build a balance sheet. Let us say this is some equipment leasing company. So we have an equipment leasing company. It's easier to imagine in the context of short-term businesses. This is the current balance sheet of the organization. What they have right now, they have equity of 1000, writing equities and liabilities on the left hand side, and they have cash of 1000. Now what they've decided to do is to purchase an equipment. So purchase a new equipment, PPE, which would be worth 10,000. But this 10,000 would not be their self-funding, it would be borrowed. So they will have a debt now. That debt is of 10,000. So what are the terms of the debt? The cost of this debt would be 10%. Cost of the debt is 10%. And it would be repaid in 4 equal installments. It would be repaid in 4 equal installments. Are we okay here? Now, for simplicity, I would be forced to keep the cost of equity at 10%, because if you do not, if you keep the cost of equity and debt same, if you keep them different, then every year your WACC will change, because every year the weight of equity and weight of debt on the balance sheet will change. And if that changes, then we'll have to calculate multiple WACC and discount each of the cash flow at different rate, which will make the model very complex. So I'm keeping both of them as same. Let us say this equipment can be leased for 4 years, and first year it will generate a cash flow of 5,000. Second year it will, let's keep them same, that will save time. Second year 5,000, third year 5,000, 4 year 5,000. So when we say generate cash flow, this is the rental income that we are going to receive. Is that fine? Now you can think of this number as similar to FCFF. You can think of this rental income as similar to FCFF, the cash flow which is available for the entire firm. Now, of course, from this we have to reduce multiple expenses. But let us assume there are no expenses. We still have to reduce depreciation of the asset to find out net income. But what we do with depreciation, we reduce the depreciation and then to the net income we add back the depreciation, the entry would be nullified. Then we should be reducing interest, but again we end up adding the interest. Do you agree with this? So this 5,000 are to be thought as FCFF, and the way you would think, these cash flows are available for both the investors. It is available for equity shareholders as well as it is available for bondholders. So let us discount these cash flows at the rate of 10% in this example, which is your WACC, and let's find out what should be the value of firm. How much is that? 15,849. So it's a simple annuity discount. You will set 5,000 as payment, 10 is IY, 4 is N, compute present value. So valuation of the entire firm is 15,849, from which we could reduce the value of debt. How much is the value of debt? How much is the value of debt on balance sheet today? 10,000. So you calculate the value of firm, you reduce value of debt, and what it will give you is the market value or the fair value of equity, and fair value of equity in this example is 5,849. So even though your book value is just 1,000, by entering into the business you are able to create tangible valuation of 4,849, tangible additional valuation of 4,849. Are we okay here? It's possible only when? Okay, the question is asked, how is WACC still 10%? He's saying WACC would remain 10% only if equity is 50% and debt is 50%. Bolo yaar answer. Yes, it would not be, because since both the costs are same, even if the weight is 90-10 or 80-20 or 70-30, in this example WACC would always remain 10%. It would change only if the cost of equity was different and the cost of debt was different. Then for each of the year we will have to do different calculations. Is that fine? Because the cost of equity and debt is same, we don't have to worry about WACC in this example. Now let us start calculating FCFEs, assuming you have written this part. To calculate FCFE, we will have to remove whatever cash flows we pay to the bondholders, and one easy way of finding out those cash flows is to find out what is the installment we are going to pay. Do you agree with this? So your installment would be 10,000 present value, 10 IY, 4N compute payment, 3,154. So for each of the year to the bondholders, we will have to make a cumulative payment of a consolidated payment of 3,154. Some part of that 3,154 is interest, some part of that is principal. We don't need to know the bifurcation, but we know that this is the amount which is going to the bondholders. So you remove this amount, and once you remove this amount, then we have 1,846, and this 1,846 is what is exclusively available for all the equity shareholder, because whatever is cash flow towards bondholders, that is now being paid off. Agree? And once we know 1,846 is available for equity shareholder, these values we will discount at cost of equity. And how much is cost of equity? 10%. So find out present value of these. 5,851. Is it same? 5,8. How much was earlier? 490. So ignoring decimals, the valuation is same. समझ में आ रहा है? So you take FCFF discounted WACC, value of firm minus value of debt gets you value of equity, or take FCFE discounted cost of equity, it will directly get you value of equity. So the best way to think of them, if you remember in corporate finance we had claims valuation approach. Remember that approach? Claims valuation, as in you look at cash flows of the firm from who are claiming them. So preference shareholders might claim them, or bondholders might claim them, and equity shareholders will claim them. So you do present value of all these claimed cash flow, that gets you value of firm. You remove the claims of bondholders and preferred stockholders, and that gets you value of equity. That is precisely how you should be thinking of FCFF. These are the cash flows claimed by both of these parties, and FCFE, which is a cash flow claimed only by equity shareholders.